Hello, viewers. My name is Aditi Nayar, and I'm ICRA's Chief Economist and Head of Research and Outreach. Today, I have with me my colleague, Mr. Karthik Srinivasan, who's the Group Head for ICRA's Financial Sector Ratings. And today, we're going to discuss the budget for FY25, which is keenly awaited by us and all market participants. So, I'm going to start off with a question for Karthik. Karthik, what are your expectations from this budget?
Hi, Aditi, and good afternoon, everyone. With reference to the budget, last few years we have seen the government infuse capital into public sector banks, but with public sector banks doing pretty well on a balance sheet front today, not expecting any specific measures for public sector banks. However, at the same time, the public sector general insurance companies definitely need a lot more of capital. Currently, their solvency numbers are way below the regulatory requirements, and with the ambitious plan for insurance for all over the next couple of decades, that's a sector where we would want to see government take some strong action. And in terms of other parts that where we would like to see action would be, any measures by the government on ease of MSME financing or refinancing options for banks and NBFCs over there? Is there a scope to increase the credit guarantee so that the MSME sector can actually avail funds at finer rates? From banks and NBFC's point of view, clearly there are still some minor deviations or differences in SARFAESI taxation rules that are applicable to both. So given that the regulator is looking more closely at harmonizing the regulations, it may make sense to possibly look at some of these aspects as well. Couple of other things would be, in light of the current frenzy in the capital markets, maybe it's time to again look at some incentive for long-term investors, given there is a sharp increase in the retail activity levels in the capital markets. This is to ensure that we have an orderly movement in the market and everybody is sort of, provided some sort of stability and not fall victim to any market actions. I think from a budget point of view, these are some of the segments that we would like to see what the government announces.
Thanks.
Aditi, now from your side, what are your expectations from the budget?
Karthik, every budget is quite eagerly awaited by economists like me, and this is a very interesting budget. It's the first budget, the first full budget of this government's 5-year term. And we've got the interim budget estimates for FY25 to kind of, provide some sort of a glimpse into what the full budget may look like. So from a macro fiscal perspective, I think there are a couple of bits of positive news that we've had since the interim budget was presented. Firstly, there seems to be a revenue upside both on the tax side as well as on the non-tax side. So the tax revenue collections for FY24 ended up being better than what had been estimated in the revised estimates for that year. And we are hoping that that momentum will continue in FY25. So we do expect to see a modest upward revision in the tax revenue collections for in the full budget as compared to the interim budget. And also we had the higher than anticipated dividend coming in from the RBI. So between these two, we expect the revenue upside to be around 1.2 trillion rupees. And this can be, of course, either channelized toward higher spending or faster fiscal consolidation or both. And the sense that we have is that with the capital expenditure having contracted in April, May, which was expected amidst the outgoing election period, and once the full budget is presented and passed, we'll be in the middle of the monsoon months. So possibly the window for really pushing through capital expenditure will be a little narrower this time than a normal year. And we've already got a fairly healthy increase in capital expenditure that had been penciled into the interim budget. So the sense we have is that it may not be very sort of realistic to push up the capex target more. It'll be difficult to achieve a higher target in the curtailed window that we would have from, let's say, middle August onwards. And therefore, the sense we have is that we could look at the revenue upside that I was talking about earlier being maybe split equally between higher revenue expenditure and smaller fiscal deficit. So maybe we could look at about 60,000 crore of extra revenue expenditure and bringing the fiscal deficit down to around 5% of GDP instead of the 5.1% of GDP that the interim budget had penciled in. And Karthik, based on this, what do you think is the outlook for government borrowings, yields, and the implications for credit, deposit growth, etc.?
Taking off from what you just said, that the fiscal deficit is likely to come down or estimated slightly lower, which sort of seems to imply that the borrowings by the government for the rest of this year is going to be possibly lower than what was announced in the interim budget. So that would mean good for the bond markets in terms of some compression or decline in yields. Plus, the recent inclusion of the sovereign bonds in the global bond indices should again sort of help keep the yields soft. In the last couple of trading sessions that we've seen since the inclusion, the 10-year GSEC has been hovering around 7% odd. If we just add on to the fact that possibly the borrowings could be lower, government continues on its path of fiscal consolidation, we could see the yields come off a bit, which in a sense would be good for both the bond markets, the investors, as well as the borrowers in a sense. From a banking sector point of view, for FY25, clearly we expect a slowdown in credit growth, but it would still be in that vicinity of 12% odd. Similarly, deposits are likely to grow in the range of about 9.5% over the next year or so. But given the fact that the credit has been outpacing the deposits in the recent past, deposit mobilization by banks would really remain key in case one is expecting or hoping for a pickup and further pickup on the credit side. Again, while we said that it's going to be good for the bond markets in case the yields come off, the investor community is still a risk averse. We've seen increase in AUMs for pension funds, provident funds, insurance companies, mutual funds also, though largely on the equity side. It's only the better rated companies that would really be in a position to take advantage of fall in yields over the course of the year, timing of which and the quantum definitely depends on when the RBI would start cutting the rates and to what extent. But for the rest of the sector, funding from the banking source remains very key. So in that context, again, just reiterating my point, the deposit growth by banks would really be a key driver. So from that point of view, what would be the government stance? Are they going to look at avenues to make deposit more attractive? Is something that we would need to see how that comes out.
Karthik, and thank you viewers for tuning in today. And we'll be back with other conversations around the union budget for FY25.
Thank you.